Hello, this is Kevin Miller. Thank you for taking the time to view this video on what's transpired in the marketplace in 2023 with regard to the stock market. We're also going to look at the performance of each evaluator fund. We're going to look at the Morningstar category changes and then also look at the outlook for 2024. So with regard to the S&P 500 index, the majority of the return for 2023 was generated the last 8 weeks of the year. This gray line on the left-hand chart over here, that shows you the S&P 500's total return. Okay, that includes all 500 stocks of the S&P 500. It was up around 24% for the year. The green line shows you the performance that was driven by just the top 10 stocks. So only 2% of the S&P 500 generated a 62% gain. The other 490 stocks are represented by this blue line, and they only generated an 8% gain. So you can see that this market was driven by a very, very small number of stocks. In this case, these 10 that drove the stock market up by 62% on their own behalf, which carried the overall blended rate of the market to 24. In the upper right-hand corner, you can see that the concentration of stocks now exceeds 32%. So these 10 stocks make up more than 32% of the capitalization of the S&P 500. We haven't seen it at this level, for a long, long time. This goes back to 1996. You can see that when it's peaked in the past, it's declined. And I would anticipate that we're going to see a pullback with regard to this, with this measurement, because we're going to have to see the other stocks start taking off, or these stocks are going to have to start pulling back. The dark blue line shows you the performance of each of these indexes throughout 2023. The light blue line shows you where these indexes stood through October 27th of 2023. So if you look at the NASDAQ was up just a little over 20% with only about 8 weeks left in the year. Then, boom, everything went up. It ended the year up 45%. Kind of reminds me of 1999 when the NASDAQ was up 85%. And back then it was the dot-com bubble, where if you had .com in the name of your stock or company, it just seemed like it automatically went up because it was, the internet was such a new idea, and it was, everyone was trying to get in, and fear of missing out was so strong. Well, this last year, 2023, 2022 was negative. Then 2023 in January, boom, the market starts taking off, and it was artificial intelligence that drove it. And so we saw a lot of people getting in, the market taking off through the first half of the year, and then it pulled back into the end of October, and then it recovered the last 8 weeks of the year. And that's kind of what this shows you right here is in the green line. You can see it, in these 10 stocks took off, and then about the middle of the year, they kind of went back down, and then they took back off again. If you look at the overall S&P 500, again, it peaked, July, August timeframe, came back down, and then went back up. So you can see that a lot of this, the performance of these various indexes was driven by the very last 8 weeks. Some of them, the light blue lines, bars, were negative through October and ended up being positive for the year. So what drove this? Corporate stock buybacks, in our opinion, and the Federal Reserve Chairman came out and said they're going to cut rates 3 times in 2024. I've never seen them come out and make a bold statement like that. So let's look at let's look at the stock buybacks first. A stock buyback happens when companies have cash and they can give that cash to their shareholders in the form of dividends. They could reinvest it into new factories or new services, or they could just leave the money sit in cash if it's earning a decent rate of return. Another thing is they could buy back some of their own stock. Prior to 1982, stock buybacks were illegal. Laws changed in 1982 that allowed corporations to buy back their own stock. And you can see by this red circle over here on the right, how many stock buybacks there were last year. Now, some people say that's just an expression that companies feel that their stock is the best place to put their money. You also need to be aware that executives are bonused based on in number of shares. Well, if companies buy back their stock and that drives the value of their stock higher, then when these executives get their year-end bonus, a higher number times a lot of shares equals a higher bonus. And I'm not saying that is what happened, but it is something to contemplate. And it may have been the reason why prior to 82, these were not allowed, but you can see that the trend line that I drew across the peaks, stock buybacks are continuing to go up and higher as time passes on. The other thing that drove the stock market was when the Federal Reserve said they're going to lower rates. This gray line represents the Federal Reserve rate, and you can see that they dropped it, here in around 2000, 2001. They dropped it really suddenly. Then they dropped it here in 07 down to 08, 09. That was the housing bubble. Then you could see it went up, and then they dropped it again. This was due to COVID. And then you could see come 2022, it almost went straight up. You can see the blue dotted lines and the green dotted lines. The blue dotted lines are the Federal Reserve, the chairman, the board. This is where they think interest rates will go into 2025. The green dotted lines, that's the market expectations per JP Morgan. And the point is that everyone is expecting interest rates to go down. Now, why would the Federal Reserve drop rates so fast, so many times? Well, the reason being is the red line represents the S&P 500. Back in 2000 to 2002, the S&P went down 49%. From 07 to 09, it went down 56%. It went down 34% in 2020 and 25% in 2022. So when the stock market collapses, the Fed drops interest rates very aggressively, has historically dropped interest rates very aggressively to try to stimulate the economy. So you can see that in this scenario, between 2000 and 2007, the average loss was about 50%. More recently, you can see the average loss was about 30%. Why is that important? Well, we know that if an investor experiences a 50% loss in their account, they're going to need to earn 100% gain just to get back to even. If they lose 30% in their account, they're going to need a 42 to 43% gain just to get back even. So substantial losses can curtail a long-term strategy in the event that you unknowingly are exposed to those losses. Another issue that the rise in interest rates has had is on the banking industry. Right now, according to the FDIC, banks are carrying about 684, so let's say 650 to 700 billion dollars of unrealized losses on their books, because when interest rates go up, the value of the bonds that they hold are worth less than they were as interest rates continue to climb. So when interest rates go up, bonds that you're holding at a lower interest rate become worth less than what you paid for them. And that's basically what happened to Silicon Valley Bank and First Republic and Citizens Bank. And so that's a concern for us to be monitoring. I already identified that out of all 500 stocks in the S&P 500, only 10 of them really drove the market. Well, this comes to us from Fidelity, and the lower half of this screen shows market breadth or market concentration. And you can see back in 1973, the very bottom of this drawback, if you take that all the way to the right, market concentration back then was only like 26%, meaning that not very many stocks were posting performance that was better than the S&P 500. You saw it again here in 2000, where concentration was really low. And that's kind of where we're at right now. Concentration is really low. So what happened after 73? What happened after 2000? Well, this up here shows you whether the stock market went up or down. And you can see after 73, it went down about 49%. After 2000, it went down about 50%. You can see here in 07, it wasn't as concentrated, but there we had the Lehman Brothers incident, so it went down 58%. August of 20 would be post-COVID, where it went down 35%. And so then you can see we don't really have a drawback yet. But if history was to repeat itself, we could expect that there's going to be a drawback in the not too distant future as a result of how highly concentrated the market is at this time and how few of overall companies are really participating in the performance of the market, the positive performance. So let's look to see how our funds did. Okay, so the very conservative, 0 to 15, this percentage range will identify the minimum and maximum this fund will have in stocks at any time. RMS means risk managed strategy. So we are not only trying to generate good returns, we're also trying to mitigate risk. So you can see the performance of this investment as of 12/31/23 for 1 year was 5.11. You can see the 3-year return. You can see the 5-year return of 305, the 10-year. The 3 columns on the far right-hand side, that pertains to standard deviation. So the standard deviation of this fund was 5.28, 4.61, and 6.3 for 1, 3, and 5 years respectively. So in the lower left-hand corner in the table down below, you can see the percentage this fund currently has in money market, 1%, in bonds, 97%, domestic large cap, 0.5%, another 0.5% in domestic large caps, domestic small to mid caps, 0.4, and foreign stocks, 0.4. The benchmarks we use for those asset classes are to the right of that. We use money market taxable table. We use the Bloomberg US Aggregate Bond Index, Dow Jones Industrial Average, S&P 500, Russell 2000, and the EAF Index for foreign. So if we take the percentage allocated to each of these indexes times that index's 1 year return and add up the result, you would see the blended performance across those indexes would be 2.24%. That's what you see in the gray line, the bottom row, the gray row of the table up above, under 1 year. You'll see it says 2.24. So you can compare the performance of this investment versus that of its peers based on the asset allocation identical to what this investment has across these indexes. So you can look at the 3-year, the 5-year, the 10-year, look at the volatility. Typically, you want standard deviation to be a smaller number because it means less volatility. And you can see that this fund has been less volatile than the indexes at the same asset allocation across these indexes. The conservative, 15 to 30% in stocks. Again, risk managed strategy. Currently, it has 18% in stocks. Same thing, look in the lower left-hand corner down here where it says fixed income bonds. You'll see that this one only has 81% in bonds because it has more in stocks. You can compare the 1 year return of this fund versus the average of the indexes. You can see the 3-year, the 5-year, same thing. I'm not going to take a lot of time because you guys can freeze these and look at these. I will tell you that in every instance, we did not outperform the average of the indexes over the 3-month period. And that's just because we are not that concentrated with our asset allocation. We are very diversified. This fund, the conservative moderate, will always have at least 30% in stocks, but not more than 50. Again, it's a risk managed strategy. It has right now about 65% in bonds. And you can see the 1-year return versus the asset allocation across the indexes, the 3-year, the 5-year, the 10-year, the volatility, etc. Good news is our volatility for the last 1 and 3 years on average has been right around 20 to 30% less, and our returns have been more favorable. They've outperformed the average of the indexes based on the exact same asset allocation. Moderate, 50% in stocks, minimum, no more than 70% ever. Currently, it has 45% in bonds. You can see the 1-year return. I mean, it's the same story. Volatility's slightly less over 5 years, but quite a bit less over 1 and 3. The growth has at least 70% in stocks always, never more than 85. Currently has only about 73%. We are keeping our stock allocation at the lower end of the range right now, just because of the potential of a pullback in the not too distant future. Again, 1, 3, 5-year returns versus the blended performance of the indexes. The volatility is less. And then lastly, you see here with the aggressive growth fund, I thought this was interesting. We have 88% in stocks. The rest of it would be in bonds or money market. So you can see down here in the lower left-hand corner, 11.7 in bonds and another 0.5% in money market. But even with that, the 1-year return was 15.83. That was better than the Dow did last year at 13.7. It was better than the Russell Index did at 1509, and it's better than the EAF did, which EAF is a foreign index, stands for Europe, Asia, Far East. But then if you come over here and look at the volatility is very, very good relative to these other indexes. So we're very satisfied with the performance of the funds, especially when you take into consideration the amount of volatility that we are able to avoid. So let's look at the Morningstar category changes. We get asked a lot of times, why do we show the indexes as opposed to Morningstar categories? Well, our fund started in 2012, and back then they didn't have categories. So we just used a blending of indexes to show the performance back then. Then in 2013, Morningstar came out with 3 categories. And one was conservative, one was called moderate, and one was called aggressive growth. And you can see how they slotted our investments in those 3 categories. Then in 2016, they expanded and they created categories that matched very well with our funds. Allocation 85+% equity matched very well with our aggressive growth. The allocation 70 to 85% equity matched very well with our growth. Allocation 50 to 70 matched up very well with moderate. The allocation of 30 to 50 was right in line with conservative moderate, and the 15 to 30% equity allocation category worked very well for conservative. But unfortunately, Morningstar doesn't have a 0 to 15% equity allocation category. So they just put our very conservative in there. It is what it is. Now, the only difference is, as I said before, our ranges are finite. If we say, like for instance, in the moderate, if we say a minimum of 50 and never more than 70, that's the way it's going to be. We're not ever going to dip below 50% in stocks. We're not ever going to have more than 70. Morningstar back then was taking a 3-year average, which is it's close, okay, but it just still wasn't quite 100% exact. Back in 2016, we started using those categories for comparable performance because of how well they lined up. Now, again, the very conservative wasn't that great, but the other ones were really fairly representative. Then in 2022, Morningstar changed things. They decided to base their category allocation or the categorization of their funds based on anticipated volatility. So now they're anticipating not only what the volatility of the market will be, but also what the volatility of an investment will be. So what they did is basically they took the conservative 15 to 30% and moved it out of where it fit and put it in to a group of investments that can have up to 50% in stocks. Well, there's no way, if we're capping our equity at 30% and we're competing with people that can have up to 50%, we're just not going to perform comparably very well because they're using a much higher equity allocation. They did the same with conservative moderate. They moved that fund that will have 30 to 50% in stocks into a category that has 50 to 70%. So at this point in time, half of our investments are no longer matched up with the proper peer group. Then they changed them once again the next year. And you can see that the changes all happened in April. And in April 23, they decided to add capital preservation versus appreciation intentions. So again, that just sustained the miscategorization of half of the investments that we offer. In fact, if you look at the moderate allocation, one other thing I should point out, they went back to their original naming. So now the 15 to 30% equity went to conservative allocation. The 30 to 50% equity went to moderately conservative. The 50 to 70% equity went to moderate allocation, which is what it was back in 2013. And then they created the moderately aggressive allocation, and the aggressive growth allocation, or aggressive allocation, went back to what it started out as back in 2013. So the moderate allocation has between 50 to 70% in stocks. But when I go to Morningstar on December 31st of 2023, at the end of last year, and I sort the investments in the moderate allocation category, there's 754 of them. I sort them by highest allocation into stocks to lowest. The investments with the highest allocation into stocks were these top four, and they have over 100% dedicated to stocks, even though the range is supposed to be 50 to 70. How do they have over 100%? They're using call options to, they're using options to trade stocks that they don't own. So then I went to the other end of the spectrum and looked at the lowest equity allocation. The investments with the lowest equity allocation were these four, and they have as little as minus 10% in stocks. They're also using options. They're using puts, in that they're shorting the market. They're expecting the stock market to go down. So if we keep our equity allocation between 50 and 70, and if the stock market sells off, there's no way we can outperform with someone who has as little as minus 10% dedicated to stocks. Or if the stock market picks up and goes up really high, really fast, there's no way our 70% limit can outperform someone that has 100% in stocks. So they've really made a mess out of the asset allocation categories. We feel like they've kind of made them into the junk drawer of your kitchen, where you just toss things that you don't know for sure where they should fall. You just put them into these categories because there's such a diverse group of asset management services in these allocation categories. So that's why we discontinued using them, for several reasons. One, they have half of our funds miscategorized. Two, they're not adhering to the 50 to 70% limits. In fact, in the moderate allocation category, over 20%, no, almost 20%, almost 20% of the investments in that category are outside of the 50 to 70% equity. So just so you know, just throwing that out there for you. Let's look at we're looking forward to here in 2024. This was interesting. I just put this in here just for, it's just interesting that the second half of February is typically the worst half of a month for the S&P 500 and the NASDAQ. If you go back to 1928, when the S&P started and look at all the 2-week time frames, the second half of February posted the worst 2-week period. The first half of February was actually not bad. And then if you look at the NASDAQ, which started in 1985, again, the second half of February. So I would say that over the next 10 days or so, we could see some interesting performance in the stock market if these averages hold true. How's the housing industry doing? Unfortunately, the mortgage application line is trending lower. In fact, it's as low as it was back in 1995. And if there aren't applications, that means there is not much for activity. And obviously, this is a national perspective. So in your communities, it might be very robust. Some communities might be even worse than this. But on a national perspective, we don't like seeing mortgage applications drop to new lows that go back, what is that, 30 years ago. How about how are we doing as a government with controlling our expenses? We just recently crossed over $1 trillion in interest payments on our debt. That's typically, from what I understand, we spend about $900 billion a year on defense spending. So we are now spending more just paying interest on our debt than we are defending our country. This doesn't mean that we're paying off any debt. This is just the interest on our debt. And another thing, the reason why the Fed is looking at needing to lower interest rates is about 20% of our overall debt as a country is going to renew over the next 9 months or so. As that renews, because interest rates are higher than when it was written back, a few years ago, it's going to renew at a higher rate, which is just going to accelerate the amount of money that we're going to need to be paying just on interest on our debt. The banking industry, it's got a lot of stress. It's under a lot of pressure, in my opinion. I feel bad for the bankers. This bank term funding program was initiated after Silicon Valley Bank went under, and it was meant to help small to medium-sized banks. That program is evidently going to stop come March of this year. Now it can get extended, it can get, but this is just what we were notified, and this is what kind of shows with this slide. And this would add more pressure to your banking industry. How about the purchasing managers? What are they seeing? Institute for Supply Management tracks periodically purchasing managers, how many of them expect growth or decline. And you can see that as of right now, only about 5.6 the purchasing managers are experiencing any growth. And this is as low as it's been back in April of 2009. You can see there's periods when it's been up to 100%. But this is concerning that they're not seeing the growth that we'd like to see for a strong stock market. Due to the tensions and upheaval in the Middle East, shipping is going to be, the cost for shipping is going to increase until they get that resolved over there. And this is kind of what this is showing. The container ships, the pricing has gone up from right around 1,500 all the way up to probably about 3,700 per 40-foot container. So that's going to be shared back into the pricing of goods and services. And I don't think it's going to help us reduce inflation. Let me put it that way. So where is the wage growth coming from? Where's the money going? The red line represents government employees, and the blue line represents employees that are working for private companies. And you can see that the red line for the government employees is going up. And in fact, which means we're hiring more government employees, we're putting more money, the government's growing. And you can look at the line for the private sector, and it's in a trend down. There are periods where it's come back up, but this is why our economy is still holding together is because there's so much government spending going on that money is helping us sustain the markets where they are today. Year over year leading economic indicators. We think we've hit a bottom. We hope we've hit a bottom. And you can see that in the past, when we've hit a bottom, it's recovered relatively quickly. So we hope this holds true. And it indicates that, the indicators are the economy isn't quite as strong as the market is perceived to be. But then again, the market really is dominated by a very small number of stocks. So keep that in the back of your mind. And then the Fed is going to cut rates. Okay. Right now, core CPI is higher than unemployment. They've only cut rates 5 times in the past when core CPI was higher than unemployment. One time was in 1942 during World War II, and the other 4 times were during these recessions. So it's not that they haven't done it and they can't do it, but it's incredibly uncommon. And if they've done it in the past, it was, I hope we're not in a world war. I wouldn't imagine that. But it's probably going to be as a result of recession. And so I would speculate that if they do cut rates with CPI higher than unemployment, it's because they anticipate we are either going to enter into a recession or we already are into a recession. So our outlook, we are still cautious because we want to see housing turn around. Our debt levels are too high. We need to reduce interest rates. And then there's just a tremendous amount of global uncertainty. Probably one of the biggest things to keep an eye on is this Evergrande delinquency over in China. One of the largest, I think the largest real estate development company in the world. And they have gone, their values, they've had to liquidate. They've been forced to liquidate. Go ahead and go out and do some research on that. And I'd keep an eye on that because that's going to impact China. Reasons to be optimistic. Unemployment still remains low. We have a lot of money in cash, and there is the potential that interest rates will decline, which will help stimulate the economy. So, it's a little bit of 50-50. We just don't know which one has a more meaningful impact, whether to be concerned and cautious or to be more growth oriented. Our strategy for 2024 is just through the end of the second quarter to remain cautious, continue to transition into longer term bonds, because if interest rates do go down and longer term bonds typically will perform at a higher level. We will continue to rebalance our stock allocations when the stock market peaks. We will eventually deploy more assets into equities on pullbacks, and we're going to watch the Federal Reserve and see what actions they take, and then we will respond accordingly. Our expectations is that the Fed will start cutting rates in the last half of the year. Recession is still possible. The housing market will recover if or when the Fed Reserve cuts rates. Longer duration bonds should outperform the last half of 2024. Stock market's going to be volatile. It's an election year. We'll see, probably be choppy up through until the election, and then we'll see where it goes after that, after we see how the election goes. A big concern, along with Evergrande, is the US dollar being challenged by BRICS. BRICS stands for Brazil, Russia, India, China, and South Africa. They've come together, created a consortium, and for the first time in 100 years, we're seeing the US dollar being challenged as the world's reserve currency. It's my understanding that the BRICS are coming out with their own currency, and it's gold backed, or it's going to be gold backed. And it's also my understanding that other countries like Saudi Arabia, United Arab Emirates are joining BRICS. They either have or their intentions are to. So it's a concern because we have benefited from being the world's reserve currency, and we need to sustain that position. So it'll be interesting to watch this. I'd keep an eye on that if I were you. And then we are anticipating an increasing desire for our currency to transition into a precious metals backed currency. And I think the currency thing is going to be a huge element throughout 2024. And I think it's going to have significant impacts. And it could be a very positive impact on our markets, depending on how it comes together. It's just that it's going to create some opportunities to buy in at a lower spot. And that's what we're going to be looking for. Here's the disclaimer. Please take a few minutes to read this. It's all the information that we need to disclose to you, with regard to risks of investing, definitions of the various indexes, standard deviation. It's always good to read up on the prospectuses of every investment that you're in. Just take a few minutes, and this is important information that the regulators want us to pass along to you. With that, I say thank you, and I appreciate you taking the time to listen. Feel free to reach out to me with any questions, and I hope you have a great day. Thank you.